It was another positive month for global equities during March, with the all-country MSCI index rising 1.6% in local currency terms. The Australian market was also up, not by as much, around about 0.7% total return. A number of positive features in the month. Many central banks around the world have moved to a more dovish tilt, talking about interest rates remaining on hold for the foreseeable future. And financial markets have actually moved to start to price in interest rate cuts in many countries, including Australia. The tensions between the US and China also the simmering. I guess the trade talks are ongoing, and we're still hearing positive sounds coming out of those discussions. And global growth, there were fears of a global growth slowdown late last year, but most of the indicators so far this year suggest growth is slower, but nonetheless still holding up reasonably well. In terms of the major equity areas, listed property was actually the best performer. It was up 6.2% return for the month, and that was reflecting declining bond yields in Australia on the back of more expectations for lower interest rates from the Reserve Bank. Looking at some of the themes dominating global markets at the moment, within the Australian market, listed property, as just mentioned, continues to do particularly well, and the resources sector, I think, are the two standout sectors at the moment. Globally, technology has come back to the fore. The Nasdaq is still doing very well. The quality factor, so companies globally with high returns on equity are also performing quite well, and the healthcare sector as well. In terms of the outlook for global markets, I mean, it is mixed. I mean, global growth is slowing, earnings growth is slowing down. On the other hand, central banks have moved to a more neutral stance, and so interest rates, I don't think, are going to be a big negative factor for markets over coming months, unless inflation does begin to pick up again. And again, one lingering worry there is just the US labour market, given the tightness of the unemployment rate. Whether or not we do see a major acceleration in wages, I think, is the major risk for markets. But otherwise, I think steady grinding higher in equity markets seems like the most likely outcome. Hi, I'm David Bassanese, Chief Economist at BetaShares. And this has been a snapshot of my market trends report for the month of April. If you'd like to see the full report, please visit the Insights section of our website. Thanks for watching, and I'll see you again next month.